When you think of investing in an emerging markets debt, what do you think of? Too risky or faulty, or maybe opportunity? Does it not fit into your long-term portfolio? We will break it all down for you, talking about the emerging market investment opportunity right now on UBS Trending. Hi everyone, and welcome to UBS Trending. I'm your host, Ainsley Carbone. Alejo Trawanko is back in the studio to break down the latest emerging market trends. Let's get right down into it right now. So Alejo, can you start us off, please, by telling us what does the universe of emerging market bond market look like right now, and how would you say it differs from a few years ago?
Let me start by highlighting that it's very different from that of a few decades ago. The origin of the asset class, we're talking about dollar-denominated emerging market bonds, was in the late 80s, early 90s, and back then, only roughly 3% of the countries that were present in the asset class were rated investment grade. Fast forward to today, over 50% of the countries are rated investment grade. In addition, 2 decades ago, you could only really invest in roughly 30 countries and 50 companies of the emerging world. Those numbers grew to over 70 countries and over 700 companies. So there's been quite a bit of change. I would end by highlighting the geographic composition and representation of the asset class. 20 years ago, companies and countries were mostly from Latin America and Asia. Today, you've got representation from these two regions, in addition to Europe, the Middle East, and Africa. So the ability of investors to express a view, to diversify, to get exposure to different regions of the world has grown tremendously.
Yeah, it sounds like a significant amount of growth in that market. So can you touch on and tell us a little bit about how investors have done in emerging markets or emerging market bonds recently in the prior years, and how would you say that compares to other fixed income segments such as U.S. Treasuries or U.S. investment grade bonds?
Hand in hand with the evolution of the universe of emerging market bonds, what we've seen over the last 2 decades is an environment of total returns by investing in developing country bonds that has been pretty competitive with other fixed income segments. Let me give you a concrete example. When looking over the last 20 years at dollar-denominated emerging market corporate and sovereign bonds, you could access annualized returns in the order of 6%. This is not only good in an absolute level, it is also pretty healthy relative to the volatility of the asset class. So in sum, I think you'll be able to access pretty good returns, diversified portfolios, and access areas of opportunity that are typically unavailable in other investment portfolios.
You've kind of set the stage for us. We've talked about what emerging market bonds have been in the past. I want to shift gears a little bit and kind of look towards the future. So can you please tell us, what does CIO expect from emerging market bonds for the remainder of the year, and what do you think is out there for the time beyond the remainder of the year?
For starters, I think yield levels on offer by emerging market bonds are pretty attractive. You can, for instance, access 7% average interest rates for dollar-denominated emerging market corporates, 8% interest rates on average for emerging market sovereigns. And if you consider our expectations for spreads over U.S. Treasuries for the asset class to remain roughly constant over the next 6 to 12 months, this means that total returns should be in line roughly with yields. In other words, if you invest in emerging market bonds denominated in US dollars, you should expect to achieve returns in the vicinity of 7 to 8% in US dollars, looking 12 months out. Now, from a more strategic, longer-term perspective, returns should also be healthy, should be very competitive vis-a-vis other global fixed income segments. So we think emerging market bonds have a role to play in strategic portfolios.
I know that some could argue that high US interest rates along with a strong dollar could hurt emerging market bonds, but I'm curious to hear, what are your thoughts on that?
Without a doubt, I think history shows very clearly that when the US dollar strengthens, this is not great for emerging market assets broadly, because typically a strong dollar tightens financial conditions in the emerging world and therefore makes it more difficult to pay back debt for these countries, for these companies. All that said, our view is that even though the dollar might remain strong, it will eventually, looking a few quarters out, start to lose a little bit of its value relative to other global currencies. When it comes to interest rate levels, you're spot on. Higher interest rates in the US suck up capital from the periphery, bring it into the core. This is not great news for emerging markets. However, once again, our house view is maybe we're reaching peak interest rate levels in the US. It's more likely than not in our assessment that the Fed will follow the lead of other developed and emerging market central banks and eventually start to cut interest rates, which could be supportive of emerging market assets.
We only have a few moments left here, so last question would be, what macro factors should emerging market bond investors really be worried about right now? Is it war, trade tariffs, global inflation? Where should the focus be?
I think all of the above, of course. I would maybe also add, over the next 6 to 12 months, what's the likelihood of a meaningful economic slowdown in the United States? This can really affect the investment outlook for emerging market bonds. And how is the Fed, the US Central Bank, likely to react to inflation and economic activity prints out of the US? I think those are the things that we should be looking at most closely, in addition to other areas you highlighted, such as geopolitics and even politics, right, with the US election picking up steam in coming weeks.
Thank you. And then lastly, one quick thing. I know we talked a little bit about what investors might be worried about. Where would you say in the last 30 seconds or so would you focus for the opportunity?
I think we need to be cognizant of the fact that there are many emerging market countries with healthier balance sheets than developed market countries. And there are many emerging market companies which much better looking balance sheets than developed market companies. So if you limit your investment universe to just the developed world, you're missing out on a whole range of opportunities in the emerging markets.
Well, thank you so much, Alejo, for coming in. It was nice to speak with you today.
Thank you for having me.
For more information, visit ubs.com/views. Make sure to follow UBS on social media, LinkedIn, Facebook, Instagram, X, and check out our Instagram channel at UBS Trending for UBS Studios content that you can't find anywhere else. And as always, if you have any questions about your portfolio, please speak with your financial advisor. Until next time, I'm Ainsley Carbone. Have a great rest of the day, and remember to keep your eyes on what's trending.